going back to 1871, there's actually multiple times where the stock market has negative returns or barely positive before inflation. And it lasts anywhere from 13 years to 20 years. And that can really impact people's investment planning and their retirement planning.
Valuations are a little bit like a weather forecast, right? They can say it's a tornado watch, but to what extent do you want to let it ruin your day at the beach?
You anchor to whatever the highest value of your statement is. Even if you took money out, you're like, well, I had $1 million and now I took money out and the market fluctuated and I've got 960 and I'm not going to be happy until I'm back over $1 million. It's just some of the things that we deal with as human nature.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks podcast. I am your host, Brandon Ducharme, and today I'm joined by Ryan Gorman, who is a CMT and a CFA charter holder out in Michigan with Tamar's Financial. He's the chief investment officer there. And Ryan is so close, probably by the time this episode goes live, that I think the white paper will probably be out, but has been working on an interesting white paper about navigating lost decades. And so when I found out, I said, that is such an interesting topic to think more about right now. So without a further ado, let's hop in. Ryan, I appreciate you taking the time to come in and talk about all this research and findings you've had. What is a lost decade?
Thanks, Brendan. Appreciate being here. I'm kind of excited to talk about this. So what we found is that, going back in history, going back to 1871, there's actually multiple times where the stock market has negative returns or barely positive before inflation. And it lasts anywhere from 13 years to 20 years. And that can really impact people's investment planning and their retirement planning.
Let's define like the market really quick, because there's, as a technician, I always say, look, there's a bull market somewhere, right? There's always a trade to be had. It's your job to sort of go out and find it, right? So if markets go up, that's great. If markets go down in a trend, that's great. You can trade around whatever. There's sectors, there's subgroups, there's some stocks that I'm sure did well in market crashes. You know what I mean? Like there's super tough to navigate, especially for kind of your everyday person. But generally when people nowadays say like the market, right, or the stock market, they're oftentimes referencing like just kind of the index fund investing that's so popular these days, right? The NASDAQ 100, the S&P 500, the Dow Jones, maybe the Russell 2000, these index funds, right? Like the low cost index funds that's trying to capture the broad market. Is that a fair analysis of kind of what you guys maybe are referencing? Like when you're talking about the market, you're not talking about a certain specific subset, but just in aggregate, like an index fund.
Yeah, that's correct.
Okay.
Yeah, and the indexes that you talk about, the S&P and the NASDAQ, they're very popular, but they're also really concentrated with a few companies. And that's not rare to now. That's historically happened plenty of times. But the data that we're pulling is kind of bootstrapped from a lot of different sources. And it's technically referenced as the U.S. equity total return. So it's looking at the broad equity in the U.S. that, so it's not index specific. It's pretty much all the equities that are available in the data set.
Okay. And so what, like, help somebody understand, like when we talk about lost decades, is that help somebody like envision what that looks like typically, or what it has looked like historically? I mean, is it just, hey, one day the stock market stops going up and it doesn't go up for 10 years, or like what actually happens?
Yeah, that's a really good point to put into perspective, because, a lot of times folks will show charts, and in the chart that we have in the white paper goes back to 1871. And so if you zoom out for 100 plus years, yeah, the market has gone up. But when you zoom into these periods of time, there's been a number of times where the market will make a high, in 1929, say, or even in 2000, and it doesn't get above that high until, in the case of 2000, the tech bubble, it doesn't get above that until the 2013. And so when you zoom out, that if you only bought at that period of time, you're underwater most of it. But there were positive years, from 2003 until 2007, the market advanced. So when you zoom in a little bit, there are positive years. It's not just a big swing, but you have to endure such large declines that it takes years to get back to the previous high water mark. And so if you're, acquiring more shares or early in your career where you're dollar cost averaging, it may be a little bit less impactful. But if you're withdrawing from it or getting close to retirement, then that flip is, the script is flipped, and you're reverse dollar cost averaging and pulling money out when the market is significantly underwater. So you have to sell more and more shares to give you the same amount of income that you could have at higher prices received. So it really is, day to day, it doesn't feel different, right? Because the market goes up and down, and most people hopefully aren't checking, daily price swings. That's what the professionals are for. But it is a period of time where your statement doesn't hit that high water mark, sometimes for many, many years. And I've been in this business for about 13 years, and I've really found that clients, and I do it as well, you anchor to whatever the highest value of your statement is. Even if you took money out, you're like, well, I had $1 million and now I took money out and the market fluctuated and I've got 960, and I'm not going to be happy until I'm back over $1 million. It's just some of the things that we deal with as human nature.
That is a real behavioral bias that I have observed people have, especially as they pull money out. I've had people say, "Man, we just didn't make a lot of money, this last year," and I'm like, "What are you talking about? You took out like 12% of your account value, and you're still up a couple percent. What do I'm going, what? How to, But in their head, they're remembering, hey, at the beginning of the year, I had 400,000, and at the end of the year, I had 408,000. Yeah, it's just not, a lot. And it's like, yeah, but if you took out 20, 30, 40 grand throughout the year, it's like, you got to add that back in. Right. And what's so interesting to me as a market timer is like the timing. People always say you can't time the markets, but it's so impactful. There's a lot on market timing I could talk about. Right. But, you ought to try, right? Like you ought to have some kind of process or decision making, because, even intra-year pulling out, cash, and whether you pull it out on a monthly basis, a quarterly basis, all at once, beginning of the year, end of the year, during a market decline or at a market high, it all makes a huge difference on the total, ending balance, years down the road. So, if measured by the stock market, you have this high water mark, and then you have these massive sell-offs. And what you're saying is like, hey, so let's use the tech. The tech bubble was one of your examples. So in 2000, the stock market hits a high water mark, right? A new all-time high. And then it sells off, and the S&P 500 had in excess of a 50% decline. That actually took, if I recall, in the S&P, that didn't bottom until 2003. Mm-hmm. It took a couple of years to actually it just kept going. It was actually really painful because it wasn't, quick and fast. It was just brutal and bleeding out. I mean, it went quick initially, but then it just kind of kept going and going slowly. But then, okay, so you get past it and that takes a little bit longer than a lot of crashes, but then you have some really great years, right? 2004, great year. 2005, great year. 2006, great year. 2007 started to look a little shaky. 2008, right in 2007, you actually, depending on whether you're measuring with dividends or without, new high, right? Mm-hmm. And then you have 2008, and if you look at the new high water, it didn't hit a new high again until 2013? Right. Say? Yep. So 2000. So essentially, what you're illustrating is like, hey, if I have in the spring of 2000 $1 million in my account, and you say, hey, my plan is I just always hold. I don't make adjustments. I don't make moves. I buy, broad market index funds, whatever. You likely never hit $1 million again until 2013. Is that essentially
assuming you weren't taking any money, like you're just holding, like you mentioned, yeah. But yeah, that's exactly right.
Yeah. And so the devastating things, like in your paper, did you look at the effect of like, well, what if somebody had to take distributions out, and what does that do? What does that extend their timeline before they ever make it back? Or do they ever make it back? Is it possible to even recover from something like that if you're living off the funds?
Yeah, I mean, at the 4% rule, we looked at two different studies. Like, so one, if you retired in '08, um, we did this study and referenced it a little bit in the first paper. But if you retired in '08 until now, with $1 million taking the 4% rule, you do have another like 700,000, but you dip below your principal for a while, and it becomes really a behavioral nightmare. I'd have to rerun the numbers of doing it like right at 2000, but that one's a lot worse, right? Because you never, you have so long before you make a new equity high that
Mm-hmm.
you definitely don't have any positive returns, and very likely if you're taking 4%, you're probably pretty close to out of money at some point during that period.
Yeah. Um, what about inflation adjusting that? Like, how long does it take to, I mean, do you ever, it's one thing to get back to $1 million, but $1 million in 2020 or 2021 is way different than $1 million in 2008.
Right. Yeah. The nominal returns were somewhere in the 3% range, from depending on what period you started. So yeah, and when we looked at the late 1960s until the 1970s, the market peaked in '66, and so you have a 16-year period where the nominal returns were barely positive, but the real returns were also negative because inflation was higher then, and so that's a huge part to include, especially too with how much inflation we've had the last couple of years that weighs on people that have been in the market. A lot of people that are, maybe watching this, they were invested in those periods of time, the early 2000s, and the late '08, and again, just the behavioral, like the psychological aspect of that, because you talked about how long the 2000 bear market was. Most people, if you talk about it now, like they remember 9/11 and they think the market went down because of that. They forget that the market had been declining for like a year and a half when that happened already. And so you start to forget about how bad it was. And I remember when I came into the industry in 2012, you still had a lot of people that went through that, and they were like, "Yeah, I'm not going to buy until the market goes back up." And people were really overweight equities for a really long time. So that, all the studies that we're doing is assuming you stick to your same portfolio and don't ever change it. And, my great grandpa was a product of the Depression, and I didn't really get him to invest in stocks until way later in my career. He had never owned stocks, hardly even had money in the bank because they just didn't trust, the banking system after the Great Depression. Here's, close to 100 years later.
Yeah, I think, well, that's an interesting example. I talk on the podcast a lot about my grandpa, who kind of started this journey for our family as a self-made guy and did grow up in the Depression. He grew up in foster care. Actually, his parents couldn't even take care of him. So, he grows up on his own, having to walk along the rail lines to pick up coal that falls off of train cars to try to sell it and get himself some food. Right. After World War II, he, comes back to the States, teaches himself about money and investing, and became a huge advocate of banks. And gosh, I wish now at this point in my life, I wish he was still around to ask him, like, what helped you behaviorally just make this decision that, you saw in your lifetime, the bank runs, you saw all that distrust. He told me a story when I was a kid about, his dad and having to go to his dad, and his dad would literally bury money and it would decay. And my grandpa would say, like, it literally would decay in the earth. It's in a box in the ground. It's like got roots growing in it, and the money is literally falling apart. And he would take it from his dad and make his dad put it in the bank and get it in some money market and CDs and right. I wonder now in hindsight, I wish he was still around, that I could say, what made you have that kind of faith after going through, what you had seen early in your life, knowing well that it, right? Like if it's happened before, it can happen again, and we know that about financial markets, right? Like,
Mm-hmm, mm-hmm.
and it's just interesting, but the difference is, my grandpa, then he did own stocks, right? I kind of say, like, greatest investor ever? No, probably not. One of the greatest, human beings with the biggest hearts, probably. Guy, loved his utility stocks and did really well with IBM, but he also lost money in Enron.
Mm-hmm.
So right, like you don't have to be perfect, but what you have to do is always be prudent. And what I guess what's funny is I think if I actually talk to my grandpa and say, like, look, hey, stock market can go down for like 10 years, grandpa, I think he would almost be of the mindset, he'd be like, I don't own this whole stock market, so I don't care.
Sure. Yeah.
But it's a behaviorally very difficult thing to do these days, right? There's so much robust research on index funds, and I don't know that it's really robust, but there's a lot of it. And and there's a lot of compelling arguments, and there's a lot of influencers that point to this, and there's a lot of people that say, hey, just buy the market. Does 10% a year. You know, you don't have to do anything else. You just put it in the index fund and just forget about it, and come back. And it sounds like if you have the timeline, long enough timeline, it should mean revert to the economic principles of, like Jeremy Siegel and Stocks for the Long Run. I mean, what's the long-term average return of equity ownership, right? 7-8%.
Yeah. The data set that we have that we use for the study, when it goes back to 1871, it was about 7.1% a year.
Okay.
And so, kind of getting to your point, it's like it tends to mean revert over time. And so if we've done, the last decade has been like 12 or 14% a year, and that's looking at the S&P 500. If you were to look at the broader data set, it probably would be less. But in order to get down to that 7%, you have to have a period of time of below market returns. And a lot of folks use the CAPE Shiller PE ratio, which takes the earnings and normalizes them over 10 years on an inflation adjusted basis. And the market is pretty expensive. So that's building up a case potentially for some sort of mean reversion, trade in that instance. But yeah, if your long enough time horizon is you're going to wait for that underperformance and then come out the other side, I think that's important. And it's also difficult. I believe in risk management. Market timing, I think there's a perception of it being more perfect than it is. But what you don't know when the market is expensive and the returns have been above average is you don't know if you're going to get like one massive bear market that lasts 1 or 2 years, or you're going to get a lost decade, and that brings your returns closer to average. You can't know beforehand, and I think that's what kind of makes it a little bit difficult. But to your point, it's like there's plenty of data, whether it's trend following. We do a lot of breadth work that kind of gives signals to say, hey, when you combine breadth and valuations, maybe it's time to at some point, change the strategy a little bit. And like you said, you don't have to own the whole index. You can pick and choose stocks, whether on a valuation basis. I'm a big, momentum guy. So looking at trend, there's a lot of different ways to do it.
Yeah, I'd argue that S&P is the biggest momentum, fund out there, S&P 500. When we talk about mean reversion, I think just to try to illustrate for people what that is we know in financial markets that if you say, hey, 7% a year, nothing does like 7% a year, right? But if you say, hey, we've got 200 years of data here or whatever, and we know that equities, broadly speaking, produce a 7.1 was your example, 7.1% a year, that means that if you kind of go back to high school algebra, right, you do have a linear line on the chart. That's your, mean regression line. And simply, like if you have a long enough time horizon and a really high tolerance for pain at points, right, you simply could do the investment strategy of when stocks are in aggregate significantly below that line, you would buy them with the expectation that the return will catch up to renormalize it to a 7.1% annualized. And so on that reacceleration, you make better than that. And, the further it gets extended beyond that trend line, at some point it has to come back to the 7% line, right? And I think what you're explaining as far as the lost decade is simply from a math logistics perspective that's the period where you have to go back to the 7.1% line. And certainly post 2008, I mean, we actually haven't had a real bear market. We haven't had a correction because every correction has just gotten liquidity injection, and the government prints more money and stabilizes prices and pushes it higher and further. How far above the mean trend line, is somebody willing to go, right? What's the case, or what's the reason why somebody doesn't just today say, okay, valuations are so high, I'm a long-term investor, take all my chips off the table and, stick it in bonds, right? If you're saying the next 10 years is going to be 0% or whatever, hey, 4% on a 10-year treasury over the next 10 years sounds pretty good. What's the case for not doing that?
Yeah, I think the difficulty with valuations, the Shiller PE ratio that we referenced, and I just, you could pick the Buffett ratio. They talk about total market cap to GDP is something, Warren Buffett's talked about, and we've eclipsed, like 200%, which is higher than it's ever been. So pick a valuation metric, and let's assume that it's saying the same thing, that the U.S. market as a whole is expensive. Obviously, there's pockets of valuation that's might be cheaper. But the argument would be is like it can stay that way for a long time. There's a couple of authors that I've read that have talked about the Shiller PE ratio. It's been in the worst, most overvalued decile, and then it just keeps going and going, and now we're in the 99th percentile. So had you heeded that advice, you missed out on this run. And so I think that valuations are more like a risk measure than a timing tool, and I think that's part of the difficulty of, it's not part of a robust process just to look at, stocks being expensive. They often say that bull markets don't die of old age. They need some sort of catalyst. And so I think there has to be more to it than just looking at how expensive the market is, or even looking at returns. It's to say, okay, well, the market's done way above average return. It has to mean revert. Who knows when?
Yeah. Yeah. Jim Bianco has this idea of, bull markets don't die of old age. They get murdered. And,
Sure.
You look around, there's a lot of things that could be weapons, but you only know what a murder weapon is in hindsight.
Right.
So what the catalyst is going to be, you don't really know. But you got to look for what the opportunity sets are if you're going to try to manage that. I had another great quote I've heard is Jay Coppell. I don't know if you know Jay Coppell. He's from a Sentiment Trader. And a couple of years ago, he said, recessions are the investing equivalent of jumping out the window. And he said, valuations are not a timing tool. They will tell you what floor you're on, though. So the higher they are, the more painful it's going to be when that recession and that correction, really comes. And they're pretty high right now. But to go back to the lost decade thing, right? If we look at, if your starting point is you say like 2004, and so you say, hey, like, okay, 2004 was this great year, 2003, depending on what, segment of the market you're in, 2003, pretty good. 2004, pretty good. So you say, all right, I'm going to get in, 2005 looks good. 2006 is great. And then it falls off a cliff in 2000, end of 2007, 2008. And all of a sudden you're back to like, hey, I've lost money over the last 4 or 5 years. How does that work out? Or it's just, more simply put, it's this idea that like, if you look at where we're at right now and you say, hey, based on where the CAPE ratio is, I believe it kind of hit that trigger point in 2024 where it was high enough that it would likely trigger a lost decade. Mm-hmm. And so the challenge is if you got out of the market when that triggered and said, oh my gosh, look at the 10-year forward-looking return on stocks here is zero. So get me out of the stock market, put me in bonds. Well, you would have not done so well in bonds, likely in 2024 still, depending on what type of bonds you get into. And not only that, like you would have felt probably pretty good during the Japanese yen carry blow up. You would have felt pretty good during the tariff tantrum, right? But then like stock market still did fine net last year, right? And there's some shakeup happening in the markets right now. But the problem is like, hey, so if you punch out in 24 and say, hey, it's high enough, I'm good. Like maybe you do okay, and maybe the markets continue to struggle and be really unattractive, and they just grind it out. But behaviorally, can you tolerate it as an investor if you get uninvested and then the market does 20% a year, 20% a year, 20% a year, 20% a year, you're pulling your hair out, making 4% in treasury bonds, and then it's not till you reinvest in year 5 that you get a 60% downside washout, market crash, and then the irony of it is like what comes after that is probably 20%, 20% right, to get you back to some kind of like break even. And if it started in 24 and 2034, but the odds, if you get uninvested and then get reinvested at the wrong time and you market time that wrong, it's insanely devastating, right? Which is why I think most people try to advocate for not doing that, because they don't understand, any kind of market timing, and they think valuation is a timing tool, and it's not. But I think that's the danger of this like conversation, right? Is how do you really navigate it? I mean, in your findings, did you find anything that helps, navigate or manage this other than just saying don't own as many stocks, or, dampen your expectations of the future? How does somebody like go, okay, so, all right, hey, we're staring down the barrel of a lost decade. Now what? What do you do now?
Yeah, so we did a lot of work in terms of like trend following and things like that. I know that there's a lot of products now that try to limit the downside, using option strategies and things like that. We didn't do a lot of work on that. But trend following, does a decent job of managing the tail risk. I think one problem, you talked about it a few minutes ago, that since the great financial crisis, we've had these like quick V bottoms.
Mm-hmm.
And so trend following a single asset like stocks can be rather volatile. You can get whipsawed in and out. And so what the common thing is, like CTAs will say, well, we're going to trend follow 200 uncorrelated markets and hopefully smooth that out. But a lot of work that we've done is on market breadth, right? So Ned Davis has some research that shows since the 1960s, which is when we really got good breadth data. There's been 14 bear markets, and 13 of them were preceded by some sort of breadth divergence. So it's kind of using these tools to systematically swing at the same pitches and adjust your exposure, using tools, because then you can turn around and say, well, how do I get back in? Right? Or you don't want to get out because of a headline and then get back in because of a headline. And so it's finding ways to allocate, equities based on their risk. If you do some trend following, perhaps foreign markets, they've underperformed. And at the same time, most of my career, the valuations by the Cape have been high, and that's probably some function of how low inflation and stuff was. But on the same side of the coin, foreign markets have been deemed cheap. Everybody's been talking about how foreign markets have been, the cheap place to go on a PE basis, and yet they haven't done anything. So you can kind of use trend following to say, well, these assets, there are bull markets somewhere. Where should we be rotating? So you could rotate, I think is the big thing, but doing it in a systematic way, whether it's trend following or breadth of some of these tools that tell you what the market is doing now, I think is really important. And that's kind of where the lens of technical analysis, I think, helps. People think that technical analysis and market timing, it has to be perfect, but it's all about probabilities. Using valuations as a timing tool, both of us, we've said it's a horrible timing tool, but there is information in knowing that forward returns are poor. We just don't know how those poor returns play out.
Yeah, I think it's kind of like valuations are a little bit like a weather forecast, right? They can say it's a tornado watch, but like, to what extent do you want to let it ruin your day at the beach?
Mm-hmm.
Or
right.
a tornado warning or whatever, right? Like there could be a tropical storm developing. Do you cancel your vacation to Florida? You know what I mean? These are impossible questions to answer. It's a personal decision. And certainly if the tropical storm never materializes, you'd feel really stupid canceling your vacation last minute. If it does materialize, you're going to wish you would have.
Mm-hmm.
You don't know till you're really there. It's funny. You mentioned like the buffered, or like the products that have some kind of like buffered with option spreads or something. For anyone listening, these are oftentimes referred to as like hedge equity products or buffered ETFs. The buffered ETFs in particular, I think, have become really popular. Sometimes they're called like defined outcome ETFs too, or defined outcome funds. I found that a lot of insurance advisors that started in insurance or do a lot with insurance space tend to really like these products because they look and feel very similar to the like index universal life or index annuity type plays where, there's a quantifiable amount of downside protection, right? In exchange, you have a capped upside potential in the return. And, I've done a fair amount of study on those and presented my findings actually to our investment committee. And I actually jokingly, like I typed up an email one evening while I was actually in bed, and I just said, look, this is like, sorry to toss a white paper on you guys on a like on a Friday night. It's like it's not super refined, but here's all of my data points I've really found and thinking through this stuff, and I'll share some of them because I think it's relevant to this conversation. So people want to go use these buffered products, and the problem is they're really not scalable in a targeted way, right? So because of the way they're built, you can use them in a very super targeted way, in a one-off way that most advisors wouldn't actually use them or don't use them that way. And so as soon as you try to normalize them and smooth them out, right? So you like ladder 12 of them for like a whole monthly series, or you're rolling it every quarter or something like that, right? As soon as you try to normalize that out, what you end up with is something that looks very similar to just owning less stocks, right? Like it's just, so I'm going to use some technical terms here. So I'll define them. Obviously, you know what they are, Ryan. But if we think about beta, or, magnitude and correlation is kind of the way that I think about beta a little bit. If you have a portfolio of 100% S&P 500 and you say, okay, well, that's too risky for me, so I'm going to go into putting my whole portfolio into one of these, like, buffered ETF strategies, right? What you ultimately end up with is you say, okay, the market's down 10, well, you're going to be down 5, and the market's up, over time, right? Over a year or two, say the market's up 10% a year, you're going to be up 5% a year. Like you're just going to get half of what the market does, kind of on the downside, kind of on the upside. It's going to be about half. And so when you look at that, like kind of net of fees and flexibility and opportunity and good management, you really have the ability to say, well, I could just own half of my portfolio in the S&P 500 and hold the rest in cash or T-bills. And you actually come out with a very, very similar result. The nuance difference is, okay, well, now I have half in T-bills. So now what can I do with it that I could beat the return of T-bills? Can I add other non-correlated assets? What else can I do in a low volatility regime? What kind of bonds could I buy that give me a little bit more yield, right? And you can beat the buffered ETF idea fairly well, and have the flexibility still to, average down or buy a dip if the market crashes. So I'm actually not a huge fan or an advocate, generally speaking, of the way most people use those products. Have you done any research? So the way that I think about it is, so option A is S&P's too risky, I had to own half as much. Well, could option B be run a tactical system and just, you can be in the market, and if the market's going up, you're in the market. And if the market becomes really unfavorable, you have something that just pulls you out of the market, reduces your net exposure down significantly or altogether.
Yeah, I think that's kind of, where I've evolved to over the years. I started as a CFA and learned technical analysis after that, when, you kind of see how the market moves. And so I do think dynamically changing your positions makes a lot of sense, whether it's just going between, stocks or something else like bonds, or rotating to areas that are working. I mean, it depends kind of on your risk tolerance, I think. Because you would assume if the U.S. market is in a recession or a bear market, there's probably increased volatility in other assets, even if they are going to be net positive. I don't have the data on that. I'm just going kind of off of intuition. But yeah, using your idea of beta or market exposure, I think there's a lot of value to use, trend or breadth to say these are the regimes, or this is how the market behaves, and categorize each one of those. So like you talked about a weather forecaster, like you could say, well, we don't know exactly when it's going to rain. We can get a good idea that these are the conditions in which we tend to get heavy rain. These are the conditions that we tend to get snow. And I think you can look at the market in a similar lens and decide what kind of exposure you want, given the volatility, the drawdown. What does the VIX look like in each of those regimes? And I think that kind of, if you can develop a system like that, it resonates well with people. I've used some risk profiling software that's great. It puts like a number to the people's portfolio and to their risk tolerance. And I'm going off of memory, but let's say that the market as measured by the S&P is like a risk score of like 68. And so you come in and the market's going up and everybody's happy. You have them go through this risk profile, and their risk profile score is like 60. And so you're like, okay, well, we got to just dial back your equity exposure a little bit to bring the portfolio in line with that number. Then you come in and there's bad headlines. The market's in a correction down 10 or 15%. You give them the same questionnaire, and now their risk score is 40.
Yeah.
So do you change the portfolio, or do you have a system that's already kind of thinking the way they do and trying to, proactively, measure that risk? I think there's a lot to be said about something like that.
Yeah. What's interesting is, so we have a risk software we use, and it optimizes for expected tail loss on a daily basis. And so basically it carries basically any given day you can expect a 40% drawdown on S&P 500. And so it actually benchmarks like S&P 500 exposure is 100% or 100, right? So if you look at S&P 500, that's a risk score of 100. And, super interesting. But I think when there's a lot of those softwares, they don't look at estimated tail loss or the fat tail nature of markets. And they look at stuff like, a VAR model or standard deviation. And so all of a sudden the risk of something like S&P 500 actually gets minimized really significantly, right? Like a 68, in my software, if somebody scored out at a 68, like they're looking more like a moderate kind of client, closer to like a 60-40 portfolio almost, you know what I mean? Not 100%, S&P 500. But again, because we're looking at max drawdown, we're thinking through the terms of, what do the tail losses look like? And it gets skewed in a lot of those other softwares when, if volatility's been low for, on a daily basis, if daily volatility's been low for the last 10 years, at a lot of points, it's going to artificially suppress that because of the recency bias, and the irony is the recency bias is creeping up higher and higher at the worst possible time it would appear, right? From a long-term perspective. And so, I think my suspicion is people don't have these conversations, Ryan, and people are way too over allocated to equities with no kind of plan or risk control metrics. They've looked at it and said, man, you haven't made any money in bonds for years, right? If you've been buying and holding bonds, it's been brutal. And so everyone just overweight equities and stocks. And no one's thinking about this fat tail loss, because every time they go down, you call your old financial advisor and they say, hang on, you have the same number of shares, don't worry, and then the Fed turns on the money printer and, markets, go back up. And at some point though, like we know from a historical perspective, and I would curious if did these data points come up at all in your research or your white paper? Like we know that like that's not, you can't run that forever. You can't, I mean, I guess they could print an infinite amount of money, but look, we got bigger problems than how high the stock market's going at that point. Like, look at some South American countries the last couple of years. How high did their stock markets go? Well, their, currencies were getting inflated, ad nauseum. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you, if you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you.
Yeah, when you look at the total like purchasing power, like there's a lot to be said of that. We didn't look too much at that. That's probably the best recent example of that, because a lot of the other, older, the Weimar Republic and stuff, it's not as good of the data is not as robust. But that's a good point. Like if inflation and the economy is losing your purchasing power faster than the market can keep up with it, then it's obviously not good either.
Still not good. I think that's the use case for having, what they call real assets or hard assets in portfolios, right? That's a different type of tail risk though. It's almost right tail risk. What other interesting things did you find in your research in course of looking at lost decades and thinking through all this stuff about how to manage and navigate all of this?
I think the most interesting takeaway, and it's kind of something that I thought, but it's just about the math of how the sequence of return matters. I think we've given an example. It was probably in the video for our first white paper, but if you have 3 different portfolios that average 5% a year, they could get there in very different ways, and the math can be pretty impactful. You could average 5% a year and be way behind, somebody. Let's use bonds as an example. Let's just say you're collecting your coupon and you get a steady, return. Your outcome could be different than somebody that had significant losses and then come back. Because you decline 50%, it takes 100% to get back to where you're at. So a lot of the financial planning software, they use this average return, and it's kind of assuming that you're making that return each year, and the outcomes can be so drastic. And in Monte Carlo simulation kind of helps, with that. But it really was, when we were doing this study, to see those periods of time where it's like, oh yeah, you see the long-term chart and it's going up, 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 up. And they're like, well, if you zoom out, those are little blips. Well, mathematically, those lost decades are huge, huge blips. And so, there's a time that you kind of have to be, tactical, because the math, I think it's lost on us how impactful the math works against us when you're in a drawdown.
Explain a little bit more. What do you mean by that?
Yeah, so going back to the example, if you lose 50%, you have to make 100% to get back to where you're at. If you were to lose 100, you got to make 0. If you lose 100, you're out. But if you lose 75%, it takes 300% to get back to where you're at. And so it's just you can, I don't want to say beat the market, but you can do returns that are higher on a compounding basis when you lose less, right? Because you have a higher starting point when you're looking at each. So I think the math favors, you get the 7%, but if you can get 7% by having lower declines and more consistent returns rather than very wide dispersion returns, the compounding is so much more powerful.
Like not only that, I think it's it's easier to stay the course, right?
And a lot less gray hairs.
For the clients, for us on our side of the table, sometimes it's more, but
right.
Life's a lot easier as a financial advisor if you just tell somebody, just no matter what, just stay in there. We're just going to do nothing. I always find it a little bit crazy when people say, "Yeah, you pay me to do nothing. That's the whole point." It's like, I don't know that that's at a certain point, when this gets bad enough, which so many people don't remember 08 or the .com bust or, these other things, like that works until it doesn't. And a client just calls up the brokerage house themselves and says, "Get me out of the market. I don't care what my advisor says." And they do that. And people do that, if you don't have, if you're not responding or doing or helping them understand in a deep, meaningful way. Which and to give credit where credit's due, I think the financial planning community has tried to do a lot more education to the public about, trying to stick it out, or the value of sticking it out. And I think for a lot of things that is really good. And it's good to think that way, but it's also good to think about the math and allow math to be a tailwind for you and not a headwind that you have to somehow pay the price for. Right.
Yeah, 100%. And I think the other, interesting point about that is, like, because I agree. Every client should have a financial plan, and the portfolio should match the plan, and that's the ultimate purpose of what you're trying to accomplish. But at the same token, like, you can look at the long-term chart, or whatever the narrative to sell, buy, and hold, and you can say, look, you just have to make it through this, and you come out the other end, and you're fine. But the act of actually doing it is totally different. And the risk is that you give up at the wrong time. You can be on board 100%, but everybody has an uncle point. And so you can be on board and 100%. Yeah, I can buy and hold. I can hold it. There's no problem. I'm not going to listen to the news headlines. And yet you get to the point where you give up, and then now you're down, 40%, say, and you'll miss the initial recovery. And now you've done almost irreparable damage, because there's so much that has to be worked through. And so I've gone through this a lot, because my investment strategy is a quant, right? So I can go through and back test a lot of different strategies and see how they work, and you can always see the outcome. If I just did this, there's a X% drawdown, I could live through that. But the back test just tells you, it's like watching a movie from the end. You don't know what it was like going through this. And just one of the most impactful things for me, and not that everybody would read this book, but Andreas Klenow wrote a book called Stocks on the Move. So it's about momentum investing. And at the end, it's kind of like a diary of launching this strategy and what happened each year, what was going on, what was it like to actually execute the strategy. And to me, it was such a powerful thought experiment. So, even having the conversations with clients, and like, simulating what's it, here's your portfolio, you're down this amount of money. These are the headlines that you're seeing. Your neighbor is having their house repossessed. That's what a recession feels like. It totally changes the game.
Yeah, absolutely. I have found that talking in dollar terms to their money really helps in this conversation. I tend to, when I'm trying to evaluate a client's risk tolerance, we really don't talk about like things like standard deviation or, equity exposure. It's really like, how soon do you plan on potentially needing the money? How stable is your life and income? You know what I mean? Because that's going to help us understand, when you may need it, not like when you plan on taking the money, but when might you need to take the money. And like, then we talk a lot about what kind of risk return trade-off are you comfortable with, right? In a 1 year period, so like you could be down 9%, but you could be up 14%. Is that acceptable to you? What about down 18, but up 24? Is that better, worse, more, you know what I mean? And when we start having those conversations, I try to put it in dollar terms for them, right? So if somebody has $1 million, $1 million in retirement assets and we're talking about maximum drawdown and we're saying, hey, like where are you going to be thinking of calling up and, screaming uncle, and you say it's, 10% down, 15% down, 20% down. And it is not uncommon that somebody will say, 25% down. Yeah, 25%, I'd start to get nervous at 25% down. And you say, okay, by the way, that's like normally like that's like the second to biggest option we kind of even put on the table. And so then I'll just reframe it and say, so if you're $1 million today, you're not even thinking of, hey, do we need to do something different, change the plan? Do we need to pull chips off the table? You're not even thinking that till your account balance is below $750,000. $250,000. You're willing to ride $250,000 of downside pain. Oh, yeah. I actually now, you know what I mean? And they start thinking about the dollars differently, right? It's no longer percentages on paper. That's 2.5 years of my salary. You know what I mean? That's 6 years of distributions. That's, you know what I mean? It's like, that's all of a sudden they go, maybe I'm actually more conservative than I thought. And the problem is most people don't think in terms of max drawdown that way, right? They just think of in terms of, whatever risk score system some advisor uses, or, hey, if you're conservative, own more bonds, like, but what does it really mean? Because a 5% up or down move in the markets no one cares about that. Like okay, institutions and pension funds do, but like retail, you like us normies, right? We don't care. We're like 5% down and you go like, yeah, markets go up, markets go down. It's nothing. The markets go down 15 and you're thinking something different really quick.
Mm-hmm. Yeah. And you really made such a good point about, we got to talk about standard deviations and percentages in our role as we're building portfolios, but in terms of clients, that's just not the case. And I actually remember the time that I had that. It was like 2015. That was the first time the Dow had 1,000-point down day. And so my dad called me up and he said, wow, the Dow is down 1,000 points. Should we do something? And of course, me being, CFA at the time, I hadn't started technical analysis yet. This is kind of where that journey started. I was like, well, that's 3%. That happens on average every 3 or 4 years. Well, first of all, don't ever lead with that with a client. You kind of build into that first. But his response to me was, I don't pay my bills in percents. I pay them in dollars. Like I care about, the exact thing that you just mentioned. And so that's always stuck with me from that point.
That's I talk about that with value investors a lot of times when they, so there will be this idea. And again, I work with a lot of people off, kind of Main Street, right? So people come in with a portfolio they bought and they said, oh yeah, I bought Microsoft, or I bought Apple, or I bought, whatever, this great Visa, these companies that you would perceive, they're household names, they're perceived to be safe. And they say, well, it's a really great company. People always have to use them. They've got, I just don't see how they're going to be around forever. They're not going to go out of business. And, kind of the use case I always point to is like, we've heard this before with a company called Cisco in 2000 when they were laying out fiber. And I will have I have an IT cabinet full of Cisco equipment that I bought a couple years ago that costed me thousands of dollars, and I go, if you bought the stock in 2000 though, you didn't break even until like last year,
Yeah, it actually hit a new Yeah, yeah, it would have been last year. Yeah, so that's a long time. And
It's like, but the company was there. The company was fine. There's nothing wrong with the company. Company survived. It's still around. But like
and
you got,
they did all the fundamental things that you mentioned. Like, they had a broadband server in every, house, the routers, and it happened, but the stock was a lost decade. There's been a lot of examples of that.
And so the example is, like you don't own companies. And I know Warren Buffett, like people that are big readers of Warren Buffett are gonna, like, his whole thing was, you don't own stocks, you own companies. You got to think about the companies. You got to, but I'll have, you got to remember, like, that's Warren Buffett playing the Warren Buffett game, where he's got access to really, really, really cheap leverage from the float of the insurance companies. And he is able to then look at investments and look at that endogenous return from the cash flows. And so he's thinking, I'm borrowing money at 3% from the insurance company, or 4%. I'm getting 8% from the cash flows of the company. That's incredible. That's all I need. And I just need that to smooth out over time. I don't care. He didn't care if the index goes up 20%. He doesn't care if his friends are getting rich. He doesn't care. He's making an arbitrage play. Cash flows of internally in the company, right? That's why he was so big on value. And so he says, you got to buy the whole company. You got to buy the company and understand the company and what the company's doing, because he's expecting his return to be entirely driven by what the company's going to return to him. When you go buy like an index fund, or you go buy these companies, man, like, you got to buy value. You can't buy, well, I expect them to still be around and they're an operating company. They should be fine, because the price you pay matters. And so, like, I encourage people, don't think about buying. Like, if you're one of us normies that isn't buying the entire company, don't think about buying a company. You don't own the company. You own the stock. The company could do poorly and the stock could do great. Which one do you care about? Right? Do you say, man, this stock has doubled in price, but the company's earnings went down. I should probably, like, donate some of the money back to him or something? No, like, it's sweet, because you can't spend valuation. You can't spend shares. You can't spend, percentages. Like, you said, you spend dollars. What can I sell this thing for? And that's really, as investors, the only thing that matters, right? Is how much am I going to be able to sell this for, today, next week, next year? What's my projection? And the reality is, what right now in the markets when we're investing, Ryan, is like, dude, no one is looking at the S&P 500 being like, look at all the cash flow in these companies that I'll get paid my return out of. A PE of 25, 25 years of cash flow to just break even on your investment. Come on. It's like, no, it's a big Ponzi that you're buying S&P 500 or you're buying an index fund today, with the expectation that more money comes into the market and you get to sell it to somebody for more dollars later in the future. That's it. There's no fundamental attachment to this.
Yeah, I think framing PE ratios in terms of the payback period is really interesting, especially on some of the individual names out there. But I have a tremendous amount of respect for Warren Buffett. I think he kind of had a big influence on the early part of my life when I was more on the fundamental side. But if you think about it, and I just looked at this recently, like, I think his returns over his career has been double the S&P 500. And people are like, oh, well, active managers don't beat the market. And I know most people exempt him as an anomaly, but they don't win every year. He only beat the S&P 66% of the time on an annual basis, and yet was able to double the returns. And so that just tells you how clustered some of that stuff is. And the other thing that's interesting, because I think it's relevant to what you're talking about, I do believe there's good companies and there's good stocks, and they're not always the same thing. And if you think about what Warren Buffett's done with Berkshire Hathaway, if you manage retail portfolios for clients and they don't like what you're doing because they're looking at their statements every month or whatever, they can move to another advisor. And so that money is gone. They have to unwind the portfolio you put together for them. Warren Buffett's never, when he had partnerships, he closed down. But since he's had Berkshire Hathaway, he's never had to return capital to people. You have to sell your Berkshire stock to somebody else if you don't like his returns. And so that allows him to think about, he can actually be a holding period forever because he makes that decision.
That's such an important thing. And I want to highlight really quick that, like, advisors think this way a lot. And this is the great challenge in the industry, right? Which is really thinking through the terms of, okay, what's mathematically optimal, what's best. And then that is entirely different than what is most likely to get my client to their end destination, to their end goal. Because if clients can't sit through the pain of a stock going nowhere for 6 years and then doing a 10x, right? If they're likely if all the data says behaviorally in the third year they're going to fire you, they'll never wait for year 4 or 5 for the stock to give them the 10x. That would be their most incredible return of their whole life. Then, like, how much you have to ask yourself as a fiduciary, how much am I really helping this client if I'm not setting them up with something that they can stay the course on, right? And so that's where you get, in the institutional space, when people understand the investments on a deep level, they can sit there and they can weather that stuff out more, and they can have deep conversations about it and look at deeper analysis, right? And but when you're managing money for other people and they can redeem, right? If you're managing a hedge fund, they can just say, "Give me my money back this quarter," or they can just say, "Hey, you know what? I'm just going to call the custodian and fire you off my account, and I'm going to." The heck with you're doing. My friend showed me to put it all in index funds, and I'm doing that now. And all of a sudden, what we kind of know and observe in the industry is usually when people start making those decisions, it marks. It usually is really close to where markets turn. It's somehow really close to where markets turn when people start making those moves, right? They want out, that's usually the bottoms. They want in, that's usually the tops. You're like when you have clients calling up and saying, "Hey, we got to get more, we got to get the returns going more. We need more risk. We need more, up the risk, whatever." It's usually close to the top. I mean, that's just how I think every advisor I know agrees with this, is like this just how it works. And so, yeah, like what you're highlighting is if Warren Buffett buys, like he bought Occidental Petroleum a couple years ago and they're underwater on it. They've lost money over the course of 4 or 5 years now, lost money on Occidental Petroleum. That company over the next 10 years could absolutely, and I'm just saying it could, I have no fundamental analysis. I'm not projecting this or something. It could double, triple, quadruple in price, right?
Mm-hmm.
It could go on an incredible run, but with his structure, you couldn't fire him. Like you said, all you can say is they've never paid a dividend. They've never let money leave the company at Berkshire, right? So if you want your money out, you got to find somebody else to just buy your stock. And to them, they don't care. They have the ability to look and say, okay, everyone could dump our stock. We don't care. If you look at the last, 10 years, man, they've been holding more and more cash because they're saying like, we're not even buying our own stock. Like our stock's overvalued. We're not even buying our own stock. We're just holding cash.
Right.
Go ahead and sell, push the price down. We don't, it's like, it means nothing to them. Right? Warren Buffett, he's still alive. He just retired. We're like $70 billion or something like that. Like, it's like,
Yeah.
The guy lives in the same house he bought in the 50s. It's like you can't damage this guy by selling your stock. He doesn't care. He's got a time frame seriously longer than people could imagine, and they can't fire him. And that's unique to his entity structure, the way that he managed to set that up. Brilliant. But it's a lot of behavioral differences.
Yeah, and kind of just buttoning that up, I'm a big fan of a lot of the work that Meb Faber's done, and I think recently on some of his podcasts, he's like, "Well, yeah, you should give a strategy 10 years to find out whether or not it works." And I can't imagine anybody really. I believe him, and I agree, but if you have an accumulation period, let's say most people they start really focusing on retirement planning in their 30s and they retire when they're 60. I'm just going to make the math. That's 30% of your accumulation years that you're supposed to give a strategy before you give up. And I just whether that's a lost decade or value underperforming or whatever it is, like people don't have that kind of patience, and it just you got to be more proactive.
It is totally a behavioral thing, right? And I think Meb is actually incredibly smart, and I agree with him. Like you should give something like 10 years, but also you should hire somebody that maybe understands on a deeper level, like, man, what's the environment that this could even start working or stop working? Like, can you catch most of those 10 years, and 8 of them are really well designed for that strategy. So maybe you give up 2 of the greatest 10 years of that kind of strategy, but you get the most of it, right? Like, and this is where I think, like, truthfully, market timing comes into play, right? Like people think about market timing of like, hey, it's impossible for somebody to, buy NVIDIA today and know that it's going to go up tomorrow. And so they buy and sell and they think in terms of day trading and this sort of thing. And some of that stuff is incredibly complex. And at the same time, like, I know a lot of people that have blown up and lost all their money trading, day trading, right? I also know more people than I could count that have made successful careers making a ton of money as professional traders, timing markets on a daily basis. So it can be done. I think it's scale, and then I think just most financial advisors are not equipped to really look or understand. So they want a portfolio that's going to be robust, and try to be the most robust they can get it over the, a full 20, 30-year cycle. Right. And, kind of throw everything at the wall, see what sticks sort of idea. Where somebody that's more of a technician can look. I mean, I think like one of the things we've done is, we didn't own international for a really long time, and we're starting to rotate into international, right? Or getting, away from the dollar exposure, maybe is probably a more appropriate way to say what we're accomplishing, at least in my personal book. And that's different, but most people would say, well, you always have to own international because you never know when it's going to outperform. And it's like, well, hold on. If you never know like which day it's going to outperform. Sure. Right. But like secular changes, big 10-year, like the 10-year changes that Meb's talking about, not as difficult to position yourself for in my opinion. Right. And everything I've learned hanging out with CFAs and hanging out with CMTs, like it's easier. Logistically difficult running it and doing that for an entire book of business on clients' behalf. So it requires some technology and, operational depth, but it's not, I mean, what's your thoughts on that? Do you think I'm off base here? Or?
No, I mean, that's the whole premise of relative strength. And I think, you got to find a time frame that works. Like, you could look at a weekly basis, maybe that trades too much. And yeah, you just kind of have to design a system and a look back period that matches, what you're trying to accomplish. And I definitely think it's a worthy goal.
Mm-hmm. Yeah, I think there's like big secular trades out there to take advantage of. I mean, and sometimes there's really nothing, right? Like sometimes it might be all quiet on the Western Front, but I like managed futures is an interesting case study, right? Because everyone says, well, you always have to own managed futures, which is a trend following system, right? Because they're going to look really bad most years, but you never know the year that it's going to work really well. And, while that is generally really true in managed futures, can you identify an environment where you just say like, you don't need as much exposure to that currently in the current macro? And then I think in watching markets, there's a period where you say like, I might, hey, valuations are extremely high. Volatility is increasing. Interest rates are coming down, which lowers your, carry costs on using some leverage, right? So now you might be able to leverage part of your portfolio to free up dollars to run a managed future strategy that is going to generally be low return if it doesn't do anything. But now you have it on for a number of years. And, hey, if managed futures has a knockout of the year part, knockout of the park year, do you trim back on that? You know what I mean? Like, hey, can you identify like, hey, maybe we're at a big secular bottom of a bear market, and maybe let's rotate some of these chips off the table for managed futures. And if you look at it historically as an asset class, like I think there's the opportunity set to do that. Obviously easier said than done, and on a day-to-day basis, almost impossible. But reading the environment and saying, hey, it's time to be more concentrated in portfolios, or more prudent in portfolios, or more diversified or not. I think that it's doable. And I think, all of it, the goal, in my opinion, is always to manage that max drawdown, right? If you manage that downside, you can let the upside just kind of happen a little bit easier.
Yeah, and I think managed futures, because of the way that the correlation stuff works, like it's always interesting, and I haven't studied necessarily, what regimes they do well in, right? Because a managed future, the portfolio may never look the same again, right? It might always be changing. They could be, short the yen and long the British pound, and long stocks and short bonds, and so it may never look the exact same. It's constantly dynamic, and so when is that crisis alpha that they're known for coming, and when isn't? And I do know what you mentioned about, anecdotally, there's got to be a time that it works really well, because there's times that it doesn't work really well. And I know a lot of people, they did great in '08 CTAs in general. And so a lot of people started allocating to them, and then it kind of stunk. And, probably part of that is, they put their cash in treasuries, and treasuries weren't yielding anything.
Yeah.
for a long period of time. But yeah, you had everybody flood the asset class in a period of time where, they struggle a little bit. And so it kind of goes into, knowing which players to play at the right time.
Well, I use managed futures because it's probably one of the more difficult ones to, I think, almost time. You're essentially trying to time somebody that's timing markets, right? It's really tough. So it's got to be, not a jumpy thing, but like behaviorally, it's so tough for people to own managed futures because you have all these years where it makes you no money, and it's just volatility in a portfolio, right? It's not, risk-free return. It's return-free risk, is what it feels like most of the time. And especially if interest rates are zero, then it's even less compelling because you're going like, okay, it's really making no money. It's introducing volatility to the portfolio generally. And then, whereas like, hey, right now where interest rates have been at say like 4, it's at least typically giving you like 4% plus, whatever the return on the actual, trend following system is on top of that. When in reality, probably one of the better times to carry managed futures is actually when interest rates are lower. And what you have to do is just leverage your beta and use the cheap cost of leverage on your stock market portfolio in order to maybe make room. And I'm talking about in the retail setting, right? Like using that so that you can own a managed futures fund that you think is going to work. Otherwise, it absorbs too much of your capital. It's a drag on returns, right? So being able to position the diversifiers is really unique, but managed futures behaviorally, like I said, it's really tough, right? Because if it's crisis alpha, but your first even 10% of a drawdown, it's not giving you the crisis alpha, it feels really you're like, why am I owning this, right? And it's hard for people to just sit through that, right? My opinion, a really tough market for managed futures and trend following is when you have somebody that is able to tweet and change the world economy. Like if there's somebody that is a little erratic personality and they tweet something every afternoon that completely changes the dynamic and direction of markets for a couple of days, and then it completely gets undone and reverts back, that's a really bad environment for any kind of trend following, especially managed futures.
Yeah, too much noise, added noise to the price.
Yeah. In which case, leaning into something that has less noise and something like just an equity only trend following that uses something like breadth or something like this that has less noise to it and says, hey, look, this is a 4 or 5% move. It doesn't really matter. We're just riding this one through, right? It's just our normal stock market exposure, but has the ability to exit the trend when it ends, so to speak, or hopefully. That's maybe a more interesting way to go. I'm going way off on a tangent here, but what any additional thoughts on that? I'm trying to think through always ways like the lost decade thing really captures my attention because it's one thing to call it out and say lost decades happen, but it's totally different to say like, but okay, but what do we do now? And it's so tough behaviorally.
Yeah, and I think, in terms of what assets get fit into a portfolio, there's complicated ones and simple ones. So giving a prescription overall, I think, is difficult.
Yeah.
I think we're both in agreement of, being dynamic. So I think there's a lot of work. Ed Easterling wrote a book, and he talks about there's a time to sail and there's a time to row. And so when there's a time to sail, it's like when the valuations are low, maybe that's when you own an index fund, for instance, and you just ride the market because the data is in your back. And then when valuations are high, maybe you don't get out of the market, but maybe you add, a CTA if you think they do well when stock market valuations are high. And so you're doing something that's rowing to move the returns and thinking about it in that framework. And so there's a lot of different ways to row. And so I think finding ones that resonate with people and doing something instead of just, we're probably getting to a point where, sitting on your hands and just letting the market do its thing, the odds are against that being a favorable period of time. The odds of, doing something a little more active or tactical, whatever that means to you, we're probably getting closer to something like that. And it's time now, to start doing those life boat drills and figuring out what matches your philosophy that does well in those periods of time. And you can go back and look at the 2000s, because treasuries did okay, gold kind of did okay. That you can go back and study those, and they won't always be the same. I think the 70s, bonds didn't do great because of inflation. Maybe that's more like now. So there's some work to be done for individual people, but hopefully our white paper kind of gets the juices flowing and thinking a little bit about, hey, maybe there is something else we can do, or different places to look to park money.
Yeah. It's the important part is, I think, and you said this earlier, right? Matching up with your financial plan, because if your time horizon is truly, like I spent time last fall at a place called Ensign Peak Advisors, and so they manage it's a private fund owned by a church, and so they jokingly say, like, well, our time horizon is longer than anyone else's, and we use that to our advantage. And, so obviously the joke is, their timeline is till like, they believe it's till the second coming of Christ. And that's good and well, but like, that's way longer than my time horizon, and that's way longer than most people's time horizon. And so all of a sudden, if you say, man, well, I'm 55, I'm hoping to retire in 10 years, like that last 10 years is usually when you make the biggest impact to your retirement outlook. And you don't want it to be a flat 10 years, right? So you have to navigate that, because you're going to start drawing on assets. And if all of a sudden you don't have an investment portfolio that's aligned with your goals, aligned with your, future plans and potential changes, right? Like what's the ability to navigate changes in the world and changes in your life, then, you might just be signing up to say, like, yeah, look, hey, markets do 10% a year over 100 years. And you're like, yeah, but if you need to pull your money in the middle of that, then your time horizon was never 100 years. Right. And so that completely invalidates all the things that you're currently using to build your strategy on.
Yeah, no, I agree 100%.
So, Ryan, when the white paper comes out, where can people find it?
Yeah, I think we'll probably circulate it on LinkedIn. I'm happy to connect with folks, and we can send a copy if you want to put it in the show notes. But yeah, we're hoping that comes out pretty quick.
Okay. Well, everyone watch for it. Ryan, people just find you under your name on LinkedIn. Is that the easiest place to find you?
Yep. Ryan Gorman, up in Michigan.
Up in Michigan. I'm glad I'm able to not hold that against you, but I'm just kidding. For those listening that don't know, I grew up in Wisconsin. There's a natural rivalry across the pond there.
See, I went to high school and college in Wisconsin, so I'm the bridge of the two states.
Where did you go to school in Wisconsin?
I went to high school in West Bend, and then I went to college at the University of Wisconsin in Milwaukee.
Yeah, you went to UWM. Okay.
Yep.
I found my way to Utah after high school because I had looked at going to school at UWM. So I grew up out in New Berlin, if you remember where that's at.
Sure. Yep.
And anyways, looked at UW Milwaukee, looked at a couple of different options. Well, out of state tuition out here in Utah at the college I attended first, the Utah Valley out in Orem, Utah. The out of state tuition was cheaper than the in-state tuition for UWM. And I thought, it doesn't snow as much in Utah either. So like down in the valley. So like maybe that's just sounded good. It's cheaper and, it doesn't snow as much in the winter. So it's kind of how I ended up out in Utah. But I didn't know that you had spent time in Wisconsin like that. I knew there was something there that I liked you over, Ryan.
Yeah, no, that's good. I guess I didn't piece that together either, so I'm glad that came up.
Yeah. How'd you scoot back over to Michigan?
So this is where I grew up, and so when I took my first job, I kind of moved back to the area. I still have a lot of family over here.
Okay.
So yeah, it was tough because Michigan does tend to get more snow than Wisconsin. It's a little warmer generally, so those trade-offs. But I was always a Lions fan, even when I was in Wisconsin, and that was tough.
I can imagine that was probably pretty tough to hang out with crowds in Wisconsin. I mean, listen, I'm just a nothing fan. Like I'm not a football, fan at all. And that's tough. I can't imagine what it's like to like the opposing team. They didn't like me for not liking the Packers, right? They're just like nothing, and man, a Lions fan. Any kind of Michigan fan. Although it's probably a little bit easier though than if you would have been a Vikings fan. That
Right.
seems to be the deepest rivalry.
Yes, that, and I think even Chicago. So I think people tend to, the Lions were such an underdog, so they still kind of get a little bit, of a pass. But yeah, the Bears and the Vikings, when you're in Wisconsin, those are definitely the worst.
Yeah. Yeah, I always grew up, there's like that rivalry with Chicago, and I just never really spent a lot of time down there as a kid. And this last fall, I went out to the SIBO and the Chicago Board of Exchange, and stayed at a hotel downtown, and in the morning, like walked down to SIBO, and kind of had this opportunity to really be in the city. And I mean, like I live in St. George, Utah. I drive to work every day. It takes 10 minutes. There's no traffic, and here I am, walking on a commute with, just thousands of people on their morning walk, and the train's going overhead, and then SIBO is obviously a cool experience, right? And then afterwards, and kind of walking out to go places with friends afterwards, and go walk and get pizza and stuff, and just that experience of the city. I don't have such a bad taste in my mouth for Chicago as I did growing up. It's not so bad. I really enjoyed it.
When I was living in Wisconsin, growing up, the Red Wings were the only team that was really good. So I was a big hockey fan. And so when we lived in Wisconsin, Chicago, the Blackhawks actually weren't really good back then. And so you could get cheap seats. So we used to go down quite a bit to watch the Red Wings play Chicago. So that was a very enjoyable, those trips are always nice. I don't know if it'd be as good now. The Blackhawks have been pretty good.
Yeah, like in football, I'm at least familiar enough to generally know when somebody names a team if it's football or not, and I seem to know most of the big ones. I will not pretend to even know where. I don't even know. I remember the Red Wings from when I played like hockey on Super Nintendo as a kid briefly, and I remember that being like a good team. But I don't even remember. I don't know where they're from. Moment of vulnerability here.
Yeah, no, that's the Detroit team.
That's the Detroit team.
Yeah,
kind of figured, but Blackhawks. Wisconsin doesn't have a team, as far as I know.
No NHL team. They've got the AHL. They've got, and I think it's still called AHL, but the Admirals in Milwaukee is the minor league team.
Oh yeah, I've heard that name. But are you? Yeah. Well, maybe sometime we can link up in Wisconsin and go to like a Brewers game in the summer or something.
Sounds good. Yeah, I interned in college at the Brewers, so I didn't. They tended to hire from Marquette, so I didn't tell them I was a Tigers fan until they hired me, because I didn't want anything else stacked against me. So I did accounting for them for a little while as an internship. So great stadium, and yeah, I got to get. My wife's not been to Wisconsin, so I got to bring her over, bring the family over, and show them where I went to college.
Was that in the old stadium or the new? Well, I think they changed the name again. It's not Miller Park anymore.
It's American Family Park, I think, or something like that. Yeah. But yeah, it was Miller Park at the time, and yeah, it had the retracting roof and all that.
It's like early 2000s.
Yep.
I remember being. I'm going to date myself as pretty young here, but I think people already know it. I think I was in kindergarten when they were building that, and they had this big crane that like fell over. Like a bunch of people got hurt. They called the crane like Big Blue. I don't know why I remember that. That was like a core childhood like event though. Like Big Blue went down at this new stadium they're building downtown. It was like a big tragedy. Here I am, 26 years later laughing about it. But I'm just laughing about the things you remember as a kid, and why that's a core memory. I don't know, but
I don't necessarily remember that. But if you say Big Blue, I think IBM. So it means different things to different people.
Yeah. I always, yeah. It's funny. I don't know that I've ever heard of IBM references Big Blue. So we come from two slightly different eras, I guess, Ryan. Hey, listen, I appreciate you hopping on. I think you're the first guest to ever have a little bit of a personal conversation with me at the end. So that's cool.
Nice. I appreciate it. I think we covered a lot of ground. It's great. I think that a lot of the things that you talk about and that we kind of believe in is it's not really talked about enough. So I really enjoyed this.
Yeah, I'm glad, for anyone that's somehow still listening, me and Ryan connected because we just always were bantering with people on X about nonsense and people's, what we think is people's skewed worldviews. And so we just kind of became friends, via social media, which is, it's interesting the way that works. Like that would never have happened, 30 years ago. So,
yeah, for sure.
It's a fun world out there. So thanks again, Ryan. I look forward to it. I'm excited to read the white paper once it comes out, and maybe we'll check in on all this valuation and see kind of how the systems are doing here, sometime next year.
Great. Yeah, that sounds good.
So, okay. Have a good one out there, Ryan. We'll talk soon.